Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mark-eitel.
All right, my name is Mark-eitel, and you are tuned into the Mr. Mortgage Show. Guys, we do this each week right here, same bat time, same bat station, and you are going to walk away from this show with the information, the tips, the tricks, the strategies, the data, the inside info that you need so you can make better real estate and mortgage decisions for you and your family. And guys, there was a ton of housing news and banking news and interest rates. Lots of stuff swirling around in the headlines this week, and we are going to dive into all of that and just kind of help you navigate the noise and figure out what this really means to you and your family. Hey, and if you've got questions or comments, please call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. Jen, my producer, is womanning the hotline, and she'll get you on the air. If you prefer to shoot us an email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, type away, hit send, and she'll read your question on the air. But man, we are going to dive right in. I'm wound for sound. I'm 2 cups of coffee into this already, and I am raring to go. Guys, 2 big things happened in the world of real estate and mortgage and interest rate this week. And everybody knows about one of them, and nobody's talking about the other. And I want to talk about both real quick. So firstly, everybody knows that the big bad wolf huffed and puffed and blew another quarter-point rate hike into the interest rate environment. And by and large, that quarter-point move was kind of baked into the cake. The market expected it. There were no immediate wild swings, and, you know, the dust is settling. So everybody anticipated that. There was some encouragement thinking that maybe this is the last rate hike for a while, but I've got my own personal views on that. I'm not quite sure, but we'll wait and see. We'll let all the smiles last for the next few days. So that was the number one thing. Everybody knew it was coming. It's not a surprise, but everybody's talking about it. So, and there is some residual conversation regarding Biden's, what do they call it? Biden's mortgage tax on the rich or on the good credit people, the loan level pricing adjustments. That's still bouncing around out there. We talked a lot about it last week. I'm happy to go into it further this week if you have questions. But guys, here's what's got me the most excited, and I want to share this with you. The other piece of information that kind of flew under the radar was on CNBC.com. Diana Olick, the real estate reporter, I poke fun at her sometimes, but I really admire her. Anyway, she had a piece on Tuesday that I thought was super interesting. It was titled "Home Prices Are Back on the Rise as the Spring Market Proves More Competitive Than Expected." Guys, we talk about it all the time. We've talked about it for years. It doesn't matter what the interest rate is. It doesn't matter what the home price is. It doesn't matter what the economic condition of the global economic environment is. What it all comes down to is supply and demand. If more people want to sell than want to buy, prices go down. If more people want to buy than want to sell, prices go up. And for the 3rd consecutive month, prices are back on the rise. Now, they're not going up 10 or 15% a month like they were in the heyday, but they are back on the rise. And for 3 consecutive months, the average price has gone up. So guys, slap whoever told you to renew your lease last year because the market was going to crash and you were going to get a better deal this year, because it's just not happening. This is like a Volkswagen Beetle or a cockroach or the little engine that could. It just keeps chugging and chugging and chugging in the face of all of these headwinds, and it's all supply and demand. What else I found super interesting is it reinforces that supply and demand equation. New listing inventory is 30% down, 30% lower than pre-pandemic spring norms. So in a normal housing market, not influenced by rate or pandemic or anything, we would have 30% more listings on the market this time of year than we do right now, which reinforces there's just not enough supply to tick the market into a downtrend. And then lastly, I found this fascinating. Nearly half of homes listed today go under contract in 2 weeks. I mean, man, oh man, guys, if you were waiting for a big break in all this action, you might have waited too long, because it looks like things are back on the move. And then I want to share something with you guys. Now that we got that out of the way, I want to share a story, a win, if you will, about a young couple who read past the headlines, didn't get distracted by the noise, and are making some significant changes that are going to greatly impact in a positive way their family's future. So Jay and Annie, young couple, 2 young kids, they were doing pretty good before the pandemic, kind of building a life. They were renting a nice apartment, just, mom, dad, and the 2 girls. And the pandemic caused them a few hiccups, and they had to move back into Annie's parents' house. Well, now it's not just Annie, there's 4 of them in there, and it's cramped quarters, and they've made the best of it, but they're ready. They are so very ready to get back out on their own, and they've got a nice IRS tax refund coming this year, and they were going to use the money for first, last, and security and get rolling again. And the apartments that they were looking at are about $2,500 a month. Well, guess what, guys? They worked through a couple issues, got their credit sorted, and we've got them approved right now with an FHA loan, and they're going to use their income tax money instead of for first, last, and security. They're going to use it for a down payment because they only need 3.5%. And for $2,500 a month, they can qualify for $300,000 property, and they're finding some options out there in that price range. And here's the really cool thing. Annie's folks, as well as Jay's folks, are so excited for them taking this step that they're gifting them the closing cost money. So they're taking their tax money, and instead of putting it in first, last, and security, they're going to put it down on a piece of property, and their folks are helping them with their first house as a family. Actually, it's the first house for either one of them. But guys, they're on their way to building equity wealth because of this decision. And you know what made the difference? They focused on the most important number in the transaction. And it's not the interest rate. It's not the purchase price. It's none of those things. Guys, do you know what the most important number in a real estate transaction is? Well, you know what? Let's do it this way. Let's make it a contest. The first person who texts the right answer to the Anytime hotline, 855-462-7292. You can text one word if you want. 855-462-7292. That's the Anytime hotline. The first person that texts me the correct answer to what is the most important number in a real estate transaction when you're buying a property, I will give you a free Mr. Mortgage t-shirt. Yeah, I know. But they're cool t-shirts. But yeah, shoot your text. The first person with the right answer, I will be happy to send you a Mr. Mortgage t-shirt. We'll see how this goes, guys. I've never done this before, but it sounds like a lot of fun. So if you've got the right answer, text it to us, 855-462-7292. Otherwise, sit tight on the other side of this very short break. We'll be back with the show. We'll start taking your questions, and who knows, we may already have a winner for the t-shirt giveaway. Sit tight, guys. We'll be back right after this. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is mark-eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you are listening to the Mr. Mortgage Show. And guys, we are so glad you're with us. Hey, thanks for letting me get that little rant out of my way before we jumped into that commercial break. I just want everybody to see the forest through the trees, because if all you're focused on are the obstacles, hey, somebody shared this with me, and I think it makes a lot of sense. I'm going to share it with you now. If you're skiing in the backcountry and you're carving through the trees, guys, if you focus on the trees, guess what? Sonny Bono time, guys. You're going to smash into that tree. But if you focus on the snow, you're going to go right through those trees and have an amazing run. And I think when we hear all of this doom and gloom news, we're focusing on the trees. So I hope that made sense to somebody, and I hope I didn't hurt any Sonny Bono fans' feelings with that. But you know what I mean, guys. Just find the opportunity, because it's out there every single day. And that story that I shared to opening the show was definitely demonstrative of that. So anyway, guys, we are going to jump into your questions. I know Jen's already got some stacked up back there. But if you have questions or comments, go ahead and call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And as I mentioned, Jen is womanning the hotline, and she will get you on the air, 855-462-7292, or send us an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click the email icon, type your question in there, hit submit, and she will get it on the air for you. But hey, speaking of Jen and speaking of your questions, I'm raring to go. Let's dive right into this. Hey, Jen, are you ready? Okay, throw question number one my way.
Tanya is asking, I really need a debt consolidation refinance, but I'm afraid to pull the trigger until rates come back down later this year. How far do you think rates will drop, and when?
Wow, Tanya, thank you for that question. This is interesting because, and if you've listened to the show for any length of time, you know I'm not a big fan of the crystal ball readers, and I'm going to tell you why. Guys, last year at the beginning of 2022, coming out of the end of 2021, I released some data at the beginning of the fourth quarter of 2021 where we saw a significant upward trend forming in interest rates. Now, guys, I'm not Nostradamus. This wasn't data that I created. It was data that I found, but it was pretty clear that we were starting an upward trend. And we were talking about interest rates in the high 5 to low 6% range in 2022. Well, guess what? Everybody said I was nuts. What are you smoking? What are you drinking? Stop drinking at work. And I said, okay, guys, I feel like this low interest rate environment is long overdue from making a change. And we started to see that change. And I want to say it was October. Anyway, I'll try to find the data and repost it to the Facebook group, but it's in the Facebook group. So long story short, the reason everybody was telling me I was crazy was because the smart people in the room were saying interest rates were not going to go past the high 3s in 2022. Well, guys, they flew past 3, they flew past 4, past 5, past 6, even past 7 for a minute, and pulled back into the mid 6s. Well, all of these reports, Tanya, and you're no different, all of the reports that people are reading are the same soothsayers and the same crystal ball readers who told us last year rates weren't going past the high 3s, and now they're telling us that rates are going to pull back into the high 4s by the end of the year. I don't see it. If you look at the raw inflation data numbers and you dive past how they're polished up, I'm not seeing consistent or significant, I guess is the better word, downward pressure on inflation. It's kind of been in a flat cycle for a while. And until inflation gets under control, I think interest rates are going to hold. Now, I'm not saying interest rates are going to 10, but if you're waiting for a significant change in interest rates before you make a decision like a debt consolidation mortgage, what we call the rec refinance, right? Reduce, eliminate, and consolidate debt. Each month that you make those high interest rate credit card payments or that big car payment, I think you're just, I don't know, you're extending the pain, if you will, and you're waiting on an unknown, because I don't think rates are pulling back significantly until we get through the next 18 months. On the other side of 18 months, there's political influences, there's all kinds of things. Hopefully we get through this recessionary cycle, inflation's under control, and we might see a change. So I share that only to really kind of drive home and illustrate that I'm not so convinced that rates are coming down significantly anytime soon. And if you have a need and you're waiting until the last minute because of a rate move, you might be doing yourself more harm than good. Let me share this with you. I'm working with a client right now. We haven't closed the transaction yet, but he's in what I believe is probably a similar boat, right? He wants to do a rec refinance, and the reason is because he bought his car at the height of the craziness in the pandemic. So he way overpaid for the car, and he's been running his credit cards up too. And those interest rates are directly influenced by the Fed, and credit card interest rates are way up. So he's feeling the pinch. Now, he went to his bank and tried to refinance his car. Well, guess what, guys? He owes way more than it's worth because he overpaid for it during the pandemic. So he can't refinance it. Well, he can't trade it in either because it's overvalued, or he owes rather more than it's worth. And he can't sell it outright for the very same reason. Somebody would have to put so much money into the car to get the financing on it because he owes almost a third more than it's worth. And it's nothing he did wrong. He's got a great interest rate on the loan. He just bought it at the wrong time. So this guy can't wait any longer. And he's at the point where he says, okay, I'm going to pay off these 3 credit cards and this car payment. And yeah, his mortgage interest rate is going to go from 4.5 to 6.5. But guess what, guys? He's going to save almost $1,000 a month in his bills. And that $1,000 a month in his monthly expenses means a whole heck of a lot more to him than the current interest rate environment that we're in and how much his interest on his mortgage has gone up. And yes, long term, he's going to pay more interest for the car. Absolutely. But the reality is it's the most cost-effective solution for him to get back on track is to reduce his monthly expenses and use that $1,000 to either prepay the mortgage or to start saving some money, some investments, who knows. But I just share that story because he was going to wait and he can't wait any longer. And if you're going to pack a parachute, do it before you get on the plane. So don't wait too long because you might not be able to do it in the future. But anyway, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this break. We're going to dive into more of your questions. We'll be right back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark-Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you are tuned into the Mr. Mortgage Show, your very favorite mortgage and real estate show on the radio today. At least it's mine, guys. I hope you're enjoying it because we always appreciate the time that we spend together each week. Hey, if you've got questions or comments, you want to get them on the air, just call or text 855-462-7292. That's the Anytime Hotline. 855-462-7292. Again, call or text that number. And Jen, my producer, will get your questions on the air. She is womanning the hotline, as well as running the board and watching for your emails. Guys, emails, you can shoot them to us by going to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. Click that email icon. You can type your question there. Hit submit. She'll get you on the air. But man, that was a good question about waiting for rates to fall before you make that big decision. And we've talked about it now a couple times during today's show that, rate can't be the only factor in making a decision because oftentimes it's not going to go in our favor or the timing is just not quite right. So anyway, I thought that was a great question. If you guys missed it, double back and catch the podcast episode in a few days, and you can do that by going to mrmortgageradio.com and clicking on that top link, I think it is, says radio show and podcast. But hey, listen, the show is all about your questions and your comments, so let's keep them coming. Hey, Jen, can you throw me another question?
Luke has this question. I'm trying to buy a double wide that was relocated from a different property. My bank is saying I can't get a mortgage because it's a second set. Not sure if that's the right term, but it's a 2010 model and was professionally set up with county permits and everything. Is this doable? Thanks.
Hey, Luke, that is a great question, brother. And second set is the correct term in most municipalities. And basically what that means is the home was originally on another property, installed and most likely deeded as real property to that first installation site, and it's been relocated. Sometimes you'll hear it called a relo set, and that's just short for relocation. And it's great that it was done to code and permitted and all of that, because that's super, super important with a second set. Typically, it's not financeable with FHA or conventional. The only one of the big three, if you will, right? Government, conventional, and non-QM is VA in the government space. VA will typically finance a second set. It may require an engineer's report, but here's something super cool that I am very excited about. We just rolled out a new program for manufactured homes that doesn't have an age restriction, because you typically are restricted to homes that are 1977 or newer. And I know it's June of 1976, but it's easier for most people just to get their mind around 1977. And it can't have been originally installed somewhere else, and like this second set scenario. So this is an interesting loan program that we just rolled out, and we've started to see a lot of interest in it for this very reason. So to answer your question, if you're a veteran and you have VA eligibility, you could qualify for 100% financing on a second set manufactured home. If you're not, there is now financing available. The interest rate is a little bit higher, and it does require a down payment, and that down payment is sliding based on your credit score, but they are now available, and it opens up access to people who are trying to buy older manufactured homes, older single wides, and second set or relocated units. So I appreciate that question. I hope that helps. If you need to dig into the details around that, I'd love to have a conversation. Just give me a call off the air and walk me through the details of the property and what you're trying to accomplish, and we'll see if that program will work for you. But great question. I appreciate it. Hey, Jen. Okay, go ahead.
Ronnie has a question. I still don't understand the whole Biden mortgage fee. I'm seeing it on the news. Can you explain this? Sure seems wrong to me.
Hey, you're not alone in your confusion, brother. And it does feel wrong. I'm not an advocate of it at all. In my opinion, all of the fees should have been reduced, not just on the lower credit score borrowers. So, We've done a full show on it. I've been interviewed on a couple other radio shows and we've talked about it. But the big misconceptions that people are having is it's not an additional lump sum fee that's being added to your closing costs. And I've seen the national news get this one wrong. Those LLPAs, those loan level pricing adjustments, have been around for a long time and they're built into the interest rate. So the higher credit score, decent down payment category, they're going to pay a slightly higher interest rate. And a lower credit score, lower down payment category of borrower is going to pay a slightly lower interest rate than they did prior to these adjustments. The high credit score guy still pays a lower rate than the low credit score guy. So it does feel like Robin Hood, right? Robbing from the rich to give to the poor type of thing. And that's what has a lot of people upset. But it still costs more money in fees and interest rate to borrow if you've got a low credit score and a low down payment. And I would love to talk with you off the air if you want to deep dive this, because it is a topic that needs a lot of conversation around it. It's super confusing and it's getting misrepresented in the press right now. But the biggest thing I can say is these fees aren't new. They're not lump sum fees that are being added to your closing costs. The fees are built in to the interest rate. Doesn't make it right, doesn't make it an easier pill to swallow, but that's what's happening with it. And yep, I agree. Super frustrating, and I'm not a fan of it by any means. So hopefully that answered your question. Hey, Jen, can we squeeze in one more?
Adriana sent us this. I'm ready to buy a lot in Georgia, but I won't be ready to build for a couple of years. What is the typical down payment for a land-only mortgage?
Hey, Adriana, thank you for that. Typically a lot loan, right? This is a buildable piece of property. That's a lot loan, is going to require somewhere between 25 and 30% down. Now that varies from time to time. We've seen them with as little as 15% down, but right now it's trending with a down payment of somewhere around 25 to 35%. And usually the loan term is 20 years. Very rarely longer than 20 years. I haven't seen one longer than 20 years in a while. And the interest rate is a little bit more than a traditional mortgage. So, and I know you said you weren't going to be ready to build for a couple years, but if you're out there listening and you're thinking about acquiring a piece of land and having a home built now, you can buy the land and roll the construction costs in at the same time with what's called a construction perm loan. And if anybody has questions about that, we can deep dive it. But land only, figure 25, 35% down and a term of 20 years. So hopefully that helps. I appreciate the question. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark-Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you are listening to the Mr. Mortgage Show. And we appreciate you spending a little bit of your day with us each time that we're on the air. We certainly enjoy being with you. I hope you're having fun too. Hey, if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. Jen is standing by womaning the Anytime Hotline. and she'll get you on the air. Hey, if you prefer to do that via email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over via email. But speaking of Jen and speaking of your questions, let's keep them coming. They're my favorite part of the show. Hey, Jen, throw me another question.
Walt is asking, is it possible for two people to get a mortgage if one has no credit scores? Mine is 718, but my wife has no scores. We both have good jobs and income. Is there an option for us? Thanks.
Hey, Walt, that's a great question, my man. And this is going to require a lot more information before I can give you a rock solid answer. But I want to encourage you because it's highly likely. We've done it before. There are workarounds, and having no credit is way better than having bad credit. So we see it a lot where in younger people or in people who relocated from another country and they're just establishing a credit profile in the U.S. that they may have no credit score. And I don't know if that's the scenario that you and your wife are working with at the moment, but that's something that I see quite often. You know, we're based in South Florida, and there are a lot of people who relocate to Florida from other countries, and they've not yet established a credit profile, even though they've established citizenship. So there are workarounds. We have done it. And it's highly likely. And I'm sorry that that's not a definitive answer, but I would encourage you to give us a shout. I would love to have a conversation with you. I need to know a few more of the details, and then I can point you in the right direction. And it's something that we certainly can help you with. As I mentioned, we've done it many times before. And I'm guessing that you need both of your incomes to qualify, because if that's not the case and you just are using your income, then she doesn't even need to be on the mortgage. You certainly have a good enough credit score. 718 is a good score. If you were able to qualify on your own, you could put her on the deed of the property, but she wouldn't necessarily be underwritten to qualify for the mortgage. But if you need both incomes, there's a different workaround for that. And again, I know it's not a definitive answer. It's highly likely you can do it, and I'd love to talk to you more about it off the air. So hopefully that helps at least get your wheels turning, and give us a call if you want to dive deeper on that one. Thanks, Walt. Hey, Jen, can you throw me another question?
Lewis sent us this. I listen every week and love the show. I've heard you talk about a bank statement loan before. Can you explain how this works? I know there is some percentage I apply to my deposits. I think that's what you said.
Hey, Lewis, thanks for that, brother. I listen every week, and I love the show too, but I thought I was alone. There's another weekly listener. No, I'm kidding. I'm sure there's more than one or two of us out there. But anyway, Lewis, great question, my man. And if you don't know what a bank statement loan is, obviously Lewis does. He's heard the show before. But for new listeners, if you've just heard this term for the first time, a bank statement loan means we take the deposits, the average deposits over a 12 or 24-month period, depending on the program, and those are averaged, and there's a factor applied to them to determine what income can be used to qualify for a mortgage. And this often is the case with people who make a lot of cash income and maybe don't report it to the IRS. And, you know, I'm not pointing fingers at anybody, but you know who you are out there who likes to pay taxes, right? And, you know, it's funny. I just released a video that said, if you don't show the IRS, you can't show the mortgage guy. And this is one of those instances where we're working around that type of scenario. Someone who makes a lot of cash or tips, or most recently, it was a massage therapist that we were working with, and she travels and does in-home massages, and a lot of the money that she earns is cash, and she doesn't claim it all. So we take a percentage of the deposits that are averaged over that 12 to 24 months. Now, Lewis, you're wondering what that percentage is, right? And I can't answer that without knowing what profession you're in, because think about it like this. A handyman or a contractor or someone who has to buy supplies, right? And there's a cost associated with the income that they're generating. Those people in those circumstances, less of those deposits are actually income, because there are expenses, sometimes significant expenses, that are attributed against that income. Well, if you're a consultant or a massage therapist or a tarot card reader or a palm reader, those professions don't have a lot of expenses associated. Well, here's one that this is a real example because I've never done a mortgage for a tarot card reader, but I have done a mortgage for a financial analyst, and he worked from home on his computer and delivered his reports via email. So with the exception of whatever it costs him to turn his computer on and probably a few reams of paper, the vast majority of what he receives is income. There aren't many expenses against that type of income. And I'm not talking about tax write-offs now. I'm talking about actual money that you spend to earn the money. So in that example, we used all of the deposits as income, and we used his CPA writing a letter stating that there's no expense. Anyway, it's not as complicated as it sounds, but I need a little bit more information. But that's how it works, and hopefully that gives you a little insight, because it's really going to come down to what profession you're in. But brilliant question, my man. I appreciate it. Hey, Jen, can we get another question in?
Nick sent us this text. We're looking at condos, and some realtors are telling us some buildings require 25% down and others allow a smaller down payment. Does this sound right? Can they really dictate that? Seems like discrimination to me.
Hey, I get it. Super frustrating. And I seriously doubt it's the building dictating that down payment. It's most likely what we call a non-warrantable condo. Oftentimes it's because of the budget. There's not enough money in reserves. And in those instances, lenders want you to put a larger down payment down on a non-warrantable condo because the equity is what shields them against loss. Because if they have to foreclose on a property that has a 25% down payment, it's far more likely that they're going to recoup all their expenses than if there was only a 3% down payment. And part of how they determine whether they're willing to do that in a condo scenario is by looking at the budget, by looking at the deferred maintenance, by looking at the expenses associated with the condo, how many of them are rental units versus how many are owner occupied. And there's formulas around all of that that determine whether it's warrantable or not. And if it's warrantable, then you have access to many different loan programs. If it's not warrantable or non-warrantable, then you're in a space that requires a larger down payment. So my guess is that that's probably the scenario. It's far more likely that it's an issue with the budget, and you can ask the agents that. You can flat out ask them, is this a non-warrantable condo? Because you're going to want to review all the docs anyway. You're going to want to buy into a financially sound building complex. You're not going to want to buy into a complex. Well, I don't know. Maybe you do. Maybe you don't care. But you have the full right and responsibility to yourself, quite honestly, to review those condo docs and make that decision for yourself. But I'm guessing where you are with this is it's highly unlikely that it's the building saying that, although it may be. It's more likely that it's a situation of warrantable versus non-warrantable condo. But anyway, I'm happy to discuss that in length with you. If you need more info, just give us a call, 855-462-7292, and I'll walk you through all of that. Hey guys, but you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight after this short break. We're going to come right back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark-eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you've got questions or comments, call or text 855-462-7292. That's 855-462-7292, or shoot us an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and type away, hit send, and Jen will get your question on the air. Hey, and she just reminded me during the break that I forgot to mention Jeremiah from 608 area code. If you are Jeremiah and your area code is 608, you won the t-shirt giveaway. You were the first person to text the right answer to the question I asked to open the show, which was, what is the most important number in a real estate transaction? Not interest rate, not price, not down payment, not even credit score. Jeremiah got it right. It's the budget, the monthly payment. Guys, that's the most important number. So great job, my man. Text me back your address from that very same number so I know it's you. And I'll send you, also include the size, your t-shirt size, and we'll send one out to you this week. Thank you for playing along. We had a lot of interesting answers and a couple that I can't repeat on the air, but let me throw it over to Jen so we can keep the questions coming. What do we have?
Tony wants to know, is there a specific way I need to ask a seller to help pay my rate buy down? I don't want to seem desperate, like I'm not qualified. Things seem to be getting competitive again, and I'm second guessing whether I should ask.
Hey, Tony, that's a brilliant question. And man, I want to first say thank you for that because that's a great one. And you're right. It depends on how you ask. And one thing that you mentioned that I think is helpful is you said, how do I ask for help with a rate buy down? And I really think that's the magic in all of this because everybody's frustrated by interest rates, even though we know it's not the most important number in the transaction. It's the one that gets all the headlines. And the sellers, guys, they know this too, although they're starting to feel like they have the upper hand again because of the supply and demand equation. But my suggestion to everybody is when presenting an offer with a seller contribution, lead with, we're using the contribution to buy the rate down. And the language can be written that the seller agrees to contribute up to X percent or up to X dollars towards the buyer's interest rate buy down, closing costs, third-party fees, and non-allowable fees. That type of languaging, and if you need specific help with that, call us off the air. That type of languaging will allow you as the buyer to apply that contribution to anything, but you lead with the fact that you're buying the rate down because the seller gets that too. But if you say, hey, I need help with my closing costs, it starts to feel like this might be a circumstance where the buyer can't really afford the property. So I get what you're saying, and I think that's a brilliant question, and you always want to lead with strength. At least that's what I was always taught. I think asking for a rate buy down makes a lot of sense because the sellers are going to go do the same thing when they buy a property. They're going to have sticker shock with interest rates too. So brilliant question. I hope that helps. If you need more information, I would love to talk with you off the air. If you need an agent that's super astute with crafting those type of offers, I would be happy to introduce you to an agent that's part of the Really Great Agents Network. Man, there's some rock stars in there that were getting inspections during the height of all the craziness that are getting rate buy down money now. So I'm not guaranteeing they can do it for you, but I am seeing these people do it pretty regularly. So anyway, brilliant question, and I appreciate that. Hey, Jen, do you have another question ready?
Myra sent us this question. I know lots of people are mad about the new mortgage fee the president put in place, but for me, I think I get a credit. How does this work? My credit is a 621, and I have a 5% down payment saved.
Hey, Myra, that's a great observation. And thank you for seeing the silver lining in all of this. So you're right. With a 621 credit score and a 5% down payment, you're seeing a fee reduction. It's not really a credit. And that, again, that's where the news is getting this wrong. These aren't charges and credits. They are costs that are being absorbed by the interest rate in most instances. There's always an exception to the rule. But Myra, you're not going to receive a credit at closing. You're going to receive a slightly lower interest rate. Now, if your lender wants to give you a higher interest rate and then give you a lender credit, that's a possibility, but it's not like the government is suddenly charging certain people a brand new fee and giving other people a credit. They're just charging you less of a fee than they did before they enacted the changes to the loan level pricing adjustments. So you are most likely going to see a lower interest rate. And also look at FHA as well, because there is a sweet spot in the FHA pricing. And with a 621 credit score and a 5% down payment, I think you will find that the FHA interest rate is far better, even after the LLPA improvements were put in place. But I would love to talk with you about that and help you any way we can. But I appreciate the question. Hey, Jen, throw me another one. Yep, go ahead.
This is from Erica. I saw your video about not being able to use income not on your tax returns when applying for a loan, but I thought the landlord loan doesn't look at my tax returns. I'm a little confused. What am I missing?
Hey, that's Erica. Yeah, okay. Brilliant observation. And I kind of alluded to that a little earlier. So you are a TikToker, because that's where I put, yes, this old guy is on TikTok, but I'm talking about mortgages. I'm not dancing around in a bathing suit or sharing recipes, but brilliant observation. So what I was talking about was when people keep their current house and go buy a new property and they rent out the current house and all is good. You've got a tenant in there. They're paying the rent. That's great. Well, guess what? After that, if you go to refinance the new house or you're trying to buy an additional property, if you're not claiming that rental income on your tax returns, then all of the debt of that first house is being offset by your disclosed income, if you will. So if you want to offset the rental expenses on your debt to income ratio, you need to show income against it. And that's where a lot of people get confused, is because they say, I'm not making a profit on that property. I'm not even going to show the income. I just break even. And that's how they justify not showing the rental income, because they don't have to pay income tax if it's a break even proposition. And I get that. But what they've now done is they're prohibiting themselves from benefiting from that, because all of that rental income it's income. That rental money is all income, every penny of it, even if it's completely offset by expenses and no income taxes due. Now, with the landlord loan, you are absolutely correct. If you're just acquiring property as an investor, and this isn't where you've moved out of an existing home that you are renting and you're going to buy or refinance another home in the future, and that's where that example was alluding to. But you're right. If you're buying an investment property and you're using the landlord loan, we don't look at your tax returns. We look at the income from the property, and assuming that the property pays the mortgage payment and expenses against the property, boom, you're done. That's it. So brilliant observation. I apologize if it was confusing, but two completely different scenarios, but you're absolutely correct with that one. Hey, Jen, can we squeeze in one more?
Paula is asking, can I use the landlord loan to take out some cash for another property?
Hey, that's a great question. And yes, you can. That's often referred to as the BRRRR strategy, BRRRR. And I sound like a seal every time I do that, but it's buy, rehab, rent, refinance, and repeat. And the landlord loan is a great product for that. You can pull cash out. You're never disclosing your personal income. All the weight of the income side is on the property if it cash flows with the new loan amount. boom, pull the cash out, take a landlord loan, and buy another rental property. And a lot of people use that strategy and that loan product, the landlord loan, to go out there and amass quite impressive rental property portfolios. So sounds like you are on your way to doing the same thing. That was a brilliant question, and I certainly appreciate it. So, oh my gosh, guys, you hear the music? You know what that means? Oh man, we've wrapped up another week of the Mr. Mortgage Show. Where does the time go? I certainly have fun sitting behind the microphone. Hey guys, if you need us during the week, check out MrMortgageRadio.com. Everything's there, MrMortgageRadio.com. Have an amazing week. We'll be back next week right here, same time, same station.
That's a wrap. Join mark-eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and why do I hate the word sales associated with real estate mortgages? Guys, my job is not to sell you anything. I'm not trying to convince you to buy a house or to refinance a house. What I am trying to do is help you make the very best real estate and mortgage decisions after you've decided it's something you want to do. Guys, think of me as the trainer in the gym. You've already decided that you want to get healthy. You are committed, and then you engage that trainer. That trainer's not standing out in front of the ice cream shop trying to convince people to get healthy. Guys, I'm here. I'm happy to help. I'll answer any questions you have, and I'll help you get it over the finish line, whether you're trying to acquire that very first house or the next office building. Guys, I've been doing it for a long time. I love what I do, and I'm happy to help. Check us out at MrMortgageRadio.com. Again, it's MrMortgageRadio.com. It's Mark Eitel, NMLS 1929005.